All right, we are here with another Be the Exception podcast. We are here with Robin Siegel. Robin, thank you for coming on.
Thanks for having me, Kyle.
Robin is in merger and acquisitions, and he is going to talk to us a little bit today about maybe some of the details of the CrossFit sale, what's going on, kind of what the process is, what the timeline might be for the sale, and then I think we'll get into just some fun like speculation stuff maybe at the end.
That sounds great.
But yeah, tell us a little bit about yourself, Robin.
Yeah, sure. So spent all of my career in the investment banking, M&A advisory space. Started out at a smaller boutique investment bank in Charlotte, North Carolina. Moved on to a larger firm at both of those. Spent a few years focusing on representing owners in the IT services and software space, so helping them sell their businesses, mainly to private equity.
Yeah.
And then over the last couple of years, have focused on the home services space. So think any services around buildings, from HVAC, plumbing, electrical, roofing, pest control, you name it.
Okay. Yeah. And so were you specifically in, like, does M&A work like you go find somebody that's looking to sell their business and then you bring it to PE, or is it like you're contracted to like PE companies and they tell you to go find businesses to buy? Does that kind of make sense?
Yeah, great question. So it kind of goes both ways. There's two sides of services in the M&A space. The sell side is the first one you're thinking of, where we represent owners.
Okay.
Either we approach them or they approach us. And say, hey, we want to sell the business, right? Multiple reasons. Could be either, hey, I want to retire.
Yeah,
I've done this long enough. I'm ready to,
I'm done
to
with
enjoy
the grind.
life. Exactly. Or sometimes it also comes down to, this is the level I've taken a business to, and I need help growing it. Mm-hmm. I don't think I'm done growing it, but I need a partner to help grow.
Okay.
And then so that's the sell side, and then on the buy side is where we represent private equity companies in helping identify investment opportunities.
Okay.
Yeah.
Okay. And you've worked on both sides. That's correct.
On both sides, yes.
Yeah. Okay. Yeah. You like the sell side a little bit more, though.
I do.
Yeah.
I do. It's a lot more personal, I think.
Yeah.
It's fun connecting with business owners and hearing their story. Where they come from, where they've taken a business to, and really learning their lessons of what works in business, what doesn't.
Yeah.
So over the years, I've had the chance to work with some really great people and
anyone you
really
can
soak
mention?
up all that. No one famous in that sense.
Okay.
It's just all around, just good people usually.
Yeah.
So, and sell side engagements are usually long enough to the point where, and quite frankly, extensive to the point where you have to work so closely.
Yeah.
That most of the people you become pretty good friends with.
Okay. Yeah. So I think like what you're describing is like you get a very personal and close relationship with these people, and I think a lot of people's perspective is more like just sharks in the water and or like blood in the water and like sharks with specifically maybe PE or like kind of just the whole sell process of something, right? Mm-hmm. So like, can you describe maybe where that thought process comes from, and how your experience has been a little bit different, like working with maybe some of these smaller cap companies is maybe what you would call them, or just being like more personable with the sell process, if that makes sense.
Yeah. I mean, I'll say this generally. I've worked with businesses ranging from about $5 to $100 million in enterprise value. That's kind of the sweet spot range. Have worked on a few that have flexed above that, but those were a little bit more the exception. But especially in that range, you work a lot with usually founder or family-owned businesses. Okay. So there isn't any institutional money in yet, which makes, I think, a transaction in that space a lot more. You need the personal touch.
Okay.
I don't think you can run a playbook like some of the bigger deals where it's just about numbers and analysis, especially as an advisor.
Yeah.
Because clients do have to trust you, right? And the best way I've found that to happen is by really building a personal connection and showing them who you really are. Yeah. And showing them that, you have their best interest at heart. Right. Rather than, some private equity firms.
Yeah. So I guess getting more into the sale of CrossFit, like coming in with a PE company to buy CrossFit. I think we were maybe kind of chatting a little bit about like off air about some of the kind of history of CrossFit. It was like Greg Glassman was like sole owner, I think from like 2000. I think it honestly started in the late 90s is when he started it. But like from 2000 to basically 2020, he was the sole owner. Forced to sell the sold. Sold the company. PE comes in, and it kind of over the last 5 years has left like a sour taste in people's mouths. And I don't. Maybe you can kind of speak on that because like there's definitely some history behind PE and like some of the old kind of we're going to strip businesses down to their bare minimum and sell them off or for parts or whatever. Maybe you can kind of talk about that and like what new PE is and maybe some of the structure that appears to have been attempted to set up, whether successful or not, with this new with Berkshire basically.
Yeah, no, I think a big part of where this modern view on private equity comes from is really, I think, originates in the 80s.
Yeah.
Just about that time frame when private equity really got a big push in that corporate raider, stamp, you could say, label.
Yeah. Can you describe what that is, like what that is a little bit?
Yeah. So really what happened a lot back then was corporations buying a lot of different businesses, sometimes more from a financial standpoint rather than a strategic standpoint.
Okay.
They just did analysis, said, hey, by buying this, we're just going to make more money. So you had, manufacturers of electronics buy, fighter jet manufacturers, that kind of stuff,
Okay.
And alongside that came, what a lot of people call just corporate greed. So executives having massive payouts and corporate benefits like multiple jets where they would fly their families to the Caribbean for a vacation. And in the end, a corporation back then, right, had less so community values, I'd say, or missions.
Okay.
And was really more about like, hey,
bottom
we
line.
have to make profit for our shareholders. It's still technically the same, but I think things are changing, hopefully a little bit.
Yeah.
But with that, private equity had the chance to come in and say, hey, you guys are not running this right? You're buying stuff just because you can, not because you should.
Okay.
And you're paying yourself crazy amounts, so you're not really running the ship right.
Yeah.
If we come in, we can pay the current shareholders a lot more money than technically the business is worth right now, and with the goal of stripping the businesses into its separate units and selling them off because they're worth more individually than in the whole package. And that's kind of where that mentality of private equity, I think, originated.
Okay, where they kind of like saw a company that was just like, we have crazy surplus of money, we're just going to go buy whatever we want, and like CEOs overspending and stuff like that.
Yeah. And
they came in, they're like, we can make this run way more efficiently if we cut out a bunch of stuff.
Yeah.
And that way money goes back to the shareholder. Is that kind of basically what was happening?
Yeah.
And so this persona of like, PE just comes in and it cuts everything, loses people's jobs, like that's kind of like the persona of the corporate raider.
Yeah. And
okay.
I mean, it did cost people jobs, right?
Yeah.
But a lot of times also because things weren't run right. And so, sometimes when you have to
it was
turn
either,
the ship around, you have to...
Yeah. It was either cut these jobs or the entire company goes under type thing.
Kind of, yeah. I mean, over the long run, if you have a massively profitable business and then you start slacking, really, right?
Yeah.
And start making wrong decisions over time, you will, at some point, you will end up with the business going under. So
okay, yeah. So how has the PE kind of evolved since then? Was that a successful thing that they were doing? Like
from a money perspective, for sure.
Okay.
That era, these guys basically printed money left and right.
Oh, okay. Yeah.
Also because of leverage, which basically means they didn't have to put quite as much money of their own up front in. They used a lot of debt that they raise
Okay.
to finance those transactions. So that way you get sometimes crazy multiples on some of these transactions.
Real quick, what are multiples on a transaction? I think we'll probably get into some more of the details.
Yeah,
of it,
no,
but
we can talk about
can
that.
you explain that really quick?
Yeah, it's kind of like a simple way of looking at the value of the business compared to its profitability.
Okay.
So a standard metric these days is an EBITDA multiple.
Okay.
So for a business that's profitable, EBITDA stands for earnings before interest, tax, depreciation, and amortization.
Okay.
And then just, basically there in certain industries there's certain standard multiples based on size or again the industry itself, the business model that you can kind of apply to get like a rule of thumb valuation for a business.
Okay, cool. Sorry.
Yeah,
Tangent. Good. Continue.
Yeah, all good. But yeah, no, so these guys made a lot of money back then and interested a lot more people into the space. But I think the way it changed over the last couple decades really is there's a lot more private equity firms out there.
Okay.
There's a few thousand in the U.S. alone, focusing from lower middle market and mid market, the kind of businesses that I've focused on in the past, to multi-billion-dollar transactions. But I think what also came with that is the realization that you can't just be corporate raiders, right? Not everyone can do that, and you're not going to get deals done, right? Because even back in that day, corporations, mostly executives, but also shareholders, try to protect their businesses from being taken over by private equity.
Okay.
And so I think the playbook has changed drastically from we're going to go in and change everything we can to make everything as profitable as possible.
Yeah.
A lot of private equity firms, especially in the lower ranges of valuations, are working with a model of let's partner with these businesses, their owners or management team, and we'll figure out what's working.
Okay.
We won't touch that because it's working.
Yeah.
And then let's get you expertise for the areas that you need improvement on.
Okay, gotcha. So I guess bring it forward a little bit to kind of and bring it back to CrossFit sale. That might have been a little bit different in regards to CrossFit kind of just like came up for sale, right? It wasn't like it was
in 2020.
In 2020,
Yep.
It wasn't like this like extensive like, yeah, Greg's getting old, like he's starting to not care about this anymore type thing, probably wants to retire. It was more just like he made a really dumb tweet and everyone got upset about it and wanted him out type thing. So what would be the difference there, like when they so when it goes up for sale, is the private equity still coming in and looking at, okay, how do we work with what we have here and kind of build this thing? Or was it like this is for sale, let's go scoop this up? Does that make sense?
Yeah. It could be either or, to be honest.
Okay.
So in general, I think private equity is under a good amount of pressure from current investors to deploy capital. So maybe just a few sentences on, I guess, how private equity works.
Yeah, that'd be great.
That might help the conversation.
Yes, yeah,
so
for sure.
Private equity teams really are investment teams that usually invest other people's money. Sometimes they invest their own money alongside deals to show they have skin in the game.
Yeah.
But most of the money that they deploy or invest comes from institutional investors. So think insurance companies.
Okay.
Their portfolios to divest a little bit, not just public stocks or bonds, but they heavily invest in private equity. Or think pension systems.
Okay.
They're usually big in those areas as well. And the way private equity gets compensated is on assets under management that are deployed, and then a cut of the profit. So the rule of thumb is like 2 and 20. If you've heard that before. So
I've heard 80-20. Is that similar or
slightly different? So 2 and 20 refers to they get 2% usually roughly on assets under management.
Okay.
And then 20% of the profits.
Okay.
Hedge funds work a little bit similar, but that's kind of like
so basically a 2% management fee.
Yeah.
And then they get paid out 20% of whatever profits are.
Exactly.
And then 80% of profits go back to shareholder, or 80, well, I guess whatever, minus management fee, and then minus 20% goes back to shareholders. Is that
exactly? Yeah,
okay?
to the investors.
To the
Yeah,
investors.
yeah.
So the investors hold a high stake in what they're wanting these PE companies to do, in some extent.
Yeah, and I
Okay.
mean, returns need to justify paying those fees, right?
Yeah.
And so they put a lot of thought in, but I guess just to run the numbers, like if you have a PE fund that has $1 billion, right? Technically, they can receive just management fees of that capital of 2%, $20 million a year. But if they only have 500 million deployed, they're only getting 10 million on that every year.
Okay.
So they kind of have that pressure internally to deploy it, to make money, but also because their investors are going to say, hey, we've given you all this money, why you're not doing anything with it.
Gotcha.
Right?
Okay.
So you have this interesting dynamic, I think, and this has been going on for a couple of years now. I think private equity still sits on, I think, $1.5 trillion of uninvested capital.
Just sits on that.
Just sits on it.
Wow.
Not intentionally, but
right.
because they keep raising records amounts of money. It's come down a little bit over the last couple of years.
Okay.
But they're still pretty active on that, and so they're really competing price-wise for deals.
Okay.
And I think what can happen too in those scenarios is you might step out of your expertise because you have money, and a deal comes up, and you say, hey, this is a great opportunity for us to deploy some capital. We do have a rough sense of what we're going to do.
Yeah.
But, maybe we're not experts in it.
Okay.
And so, yeah.
And you were kind of saying before, too, like maybe they're not experts, but they have advisors that, like tons and tons of advisors that really should be experts in the area, if that makes sense.
Yeah. So private equity usually has what are called operational partners.
Okay.
Or operating partners. These are people that usually come from big consulting companies, McKinsey, BCG, that kind.
Okay.
And those are the partners that they put in place to really help run the business or figure out, hey, how can we run this business better?
Okay.
But alongside that is always, private equity always looks at the management team. You can have a great business, but if you say, hey, as part of the sale, our management team is leaving, it's going to be a hard sale.
Okay.
Right? Because a lot of the value in a business is their existing management team.
Right.
They don't want to replace people, right?
Yeah.
Because they need internal expertise. Like every business is unique.
Yeah.
And so there's unique challenges or, just successes that only a management team that's usually been in place really knows. And so they rely on people to, internally to have an idea. Hey, this is where can we take this next?
Okay. So Berkshire, I think you, like, not trying to talk any crap on them, but I think you were doing a little bit of research and CrossFit appeared to be out of their kind of investment like realm a little bit. Is that correct or?
Yeah, it seemed, I think CrossFit in general is a very unique model. Right?
Yeah.
Generally, I'd say, it's in the consumer services sector, sports underneath that. And Berkshire's made a couple investments in the consumer side.
Oh, okay.
But just I think the uniqueness in the sports world of CrossFit, just I think made it a challenging investment.
I feel like it's a very challenging investment because you have like the affiliate side of things, which is like completely community run, and then you have this like entertainment side of things that's. But the community drives that entertainment side of things. Yeah. So it's like a very weird kind of dynamic between the two. Mm. And do you feel like they do you feel like they were heavily relying, I guess, from your research on the management team they had like CrossFit had in place and to kind of run some of the stuff. So like from the outside looking in, this is like a CrossFitter's perspective who's been in it for 10 years and like really kind of tried to pay attention over the last 5 because our business floats on that. Mm-hmm. It appears that like they started off and they kicked off all these different like products, right? They were trying to help the affiliates out more, get into the affiliates, kind of raise their ability to like sell, if that makes sense, and market for them. and it just kind of went like nowhere almost. It just seemed like it was all this headlines and then just kind of faded off, if that makes sense.
Yeah. Yeah.
And and then over the last couple of years, it just seems like, I think they did implement some stuff inside of the CrossFit Games side of things that really made sense. So one big thing that people will always clamor about is like bring regionals back is a big saying. If you've been in the sport for 8+ years, and the sport used to be the open regionals games. It was great format, but everybody kind of knew they were losing money on regionals, and so they got rid of them actually in 2018.
Okay.
And then
which was just about the height of the affiliate levels.
Yeah, because Greg came in and he shut down all social media for a year, which was crazy. That was kind of the beginning of the end, to be honest.
Okay.
Berkshire came in and they implemented quarterfinals, so now it was open, quarterfinals, semifinals games. Mm-hmm. And the quarterfinals model was actually pretty good, honestly. It was annoying because you had to do another online competition. So it was annoying for the athletes, and there's a lot of issues with online competitions in general.
Yeah.
But bottom line, it brought them in a lot of extra money with no overhead, or next to no overhead. And I think that's kind of one thing that you were saying too during your research was there wasn't a lot of room to reinvest money. Is that correct?
Yeah. You brought up a lot of things here.
Yeah, sorry, I just went on a huge tangent. My bad.
All good. Yeah, no. Let's start at front or in the beginning. I would say, given what looks like a lack of expertise on there and in this specific sector, and
okay.
I think again, CrossFit being such a unique business model in the fitness world, with its affiliates rather than a franchise system. Mm-hmm. I would say they likely heavily relied in their investment thesis on either people internally or people that are very, very close to the subject matter.
Yeah.
Because realistically, private equity doesn't usually do decisions in a rush. Like that's not how they work because they invest other people's money.
Right.
So investment teams are usually pretty small. You have a handful of people on the private equity side.
Okay.
But they have to present a business case to an investment committee, and an investment committee has to sign off before they even get to say, "Hey, yeah, we're really going to do this."
Okay.
So they put presentations together. They really, full around briefing of, this is why we're buying this, or we're thinking about buying this, and this is what we're going to do next, and this is who we're going to do it with. Okay. Right. And so I think Rosa is the one who basically took over from there.
Yeah.
From that transaction on, I'm assuming that him and whoever else was involved on the management side of things, they probably had a solid plan that they presented.
Okay.
That really convinced them to say, hey, we feel comfortable taking the risk on, even if we don't have quite as much experience. This seems like a great opportunity. But sounds like clearly that strategy, that plan wasn't implemented the way it should have been.
Yeah.
And so, things didn't turn out too well.
Yeah. And, I think some of it goes back to just kind of the death of Lazar back in August of last year. Like their numbers are significantly down from that. But even up to that
sign-ups
point,
for the games.
Yeah. And I think affiliates are down as well. Yeah. Don't quote me on that, but there's definitely a lot more disconnect or divisiveness inside the community, if that makes sense. Yeah. And I think whenever you have that, you kind of have a broken system, right? Yeah, by all intents and purposes, seemed like it was growing. I think a good catalyst to judge that is affiliate numbers, but also games signups or open signups. And the open was growing. In 2024, it reached its second highest number. Its first highest number was back in 2018. Okay. Right before they got rid of the last year of regionals was its biggest number. So it was starting to appear to be on a growth trajectory again. But then that happened, and people were just not happy with the way it was handled. There was a lot of there's a lot of shit that happened during that time frame. And so numbers are significantly down this year. But I think you were also talking about how this is kind of like the sweet spot for Berkshire to like exit, right? That 5 to 7 year or 3 to 7 year time window.
Time frame wise, yeah.
Yeah.
That's, again, I guess it kind of goes back to the structure of PE. So,
Yeah.
Private equity raises funds
Mm-hmm.
that are usually, dated to a specific time period. And the typical private equity hold time for a company is about 3 to 7 years.
Okay.
So we're kind of in that sweet spot. 5 years is a good time to exit. Obviously, with, things changing on a business side, might not be the perfect time.
Yeah.
Right?
Yeah.
So, there's a few considerations. Either they're under pressure, to return money to shareholders. So
Yeah.
they're saying, hey, we kind of need to sell because we don't want to continue investing in a business. We don't have a strong enough business case to present to our investment committee.
Right.
To say we need to hold this, we need to hold CrossFit under ownership.
Mm-hmm.
And then 2 is really, and I think this is where their announcement online comes in, right? Saying, hey, we're looking for a new owner.
Yeah.
I thought that was interesting. Right?
Yeah. Right. That doesn't
usually,
normally happen, right?
Not with private companies.
Okay.
That usually hear the announcement after the deal is closed.
Okay.
So this seems a little bit unconventional, but I can also see where it comes from. I think it gives a few opportunities for the current owners, but also future owners. So on one side, it shows really anyone out there, hey, this business is up for sale. So get started thinking of, if you want to buy this business, how can you do it the best way? Right?
Okay.
So it doesn't rely on bankers having connections and maybe reaching out only to a few people. This way, they're reaching the whole community, right? Anyone who's vaguely familiar with CrossFit now knows they're for sale.
Okay.
So if there's someone in there who has a strategy and the capital, they could be a valid buyer. And then I think on the flip side, it gives CrossFit, but also I think potential buyers, the opportunity to see what the community is saying. So just like the way we're doing a podcast now about it, talking about it,
yeah.
right? And, there's been most likely many others who've talked or written about it.
Yeah.
And so all of those opinions can, I think, be helpful in finding the next partner.
Oh, okay. Interesting. Yeah. Is it possible, too, that they're doing this because they know the numbers don't look great and trying to go to, like a banker to connect them with other PE companies would be a tough sell for those companies? And so they want somebody that's like passionate about CrossFit to take it over?
I think it feels like you need someone passionate to take over.
Yeah.
Right? Because I think the passion is going to drive the strategy. This is where this uniqueness comes in of, the community drives the business, right? That's why an event like last year or Glassman's tweet, like all of those have such a huge impact on the business. Affiliates leaving, less people signing up for the games, etc.
Yeah.
So it's not your typical business case, I think, where you can just bring someone in who says, I know how to structure operations, and that's why we should buy this business. It doesn't feel like that's enough in this case.
Okay.
Yeah.
Okay. Interesting. Yeah. And so I guess maybe kind of furthering down the announcement road, because it's very interesting. Like, we're hearing all sorts of like, oh, this company's going to buy, this company's going to buy, like these companies are going to get together and buy, oh, this company started an entertainment arm, or this firm started an entertainment arm, they can be buying. And some of them seem like they're very like, yeah, I was told this by this person that this entity is buying it, like kind of rumor mill, but it also seems like there's possibly some validity to it. So what's going on right now in regards to like a sale of a business? Like how long, like is somebody just going to step in and boom, day one, they're going to be taking over or like running this thing, or like what's the process for buying this, and why is there so many kind of like rumors going around about who's purchasing?
Yeah, definitely a lot of speculation. Maybe to answer the second question or touch on that first, I think there's so much speculation going on because it is, publicly announced that they're looking to sell.
Okay.
So you just have a lot of people, I think, who talk and who speculate and try to figure it out. And then, realistically, there are a lot of buyers out there, especially in the most recent years, who've started investing in sports businesses.
Okay.
Right? If you think of, the most prominent ones I can think of are, Formula One teams. There are some that recently changed hands. Also with private equity, I think Alpine is an example.
Okay.
There's a few private equity firms in there. Ryan Reynolds has his hands in this one too.
Wait, Ryan Reynolds or?
Yeah, Ryan Reynolds, the Hollywood actor.
Mint Mobile?
With Mint Mobile too. Yeah,
Okay.
yeah, that guy, exactly.
Okay.
Yeah.
Okay.
So he's an
Crazy.
owner in that Formula One team.
Okay.
I think the one that you're referencing is TPG.
Yeah.
Private equity firm based here in the U.S., but really investing globally. They have a few $1 billion assets under management, so they're not small for sure.
Yeah.
Looks like they've partnered up with the golfer Rory McIlroy, I think is his name.
Yeah.
Having a prominent figure in something like sports investing, I think is pretty important.
You kind of need almost like a face to sell, kind of, or
I think it helps with credibility.
Okay.
Because realistically, like it's good having an athlete, I think, on a team.
Yeah.
You could call it. I'm sure he's investing some of his own money too.
and he could act as like an advisor to the sport, right?
Yeah.
Or,
Yeah, but I think every sport usually is so unique that, I think realistically it's probably going to be tough for, a golfer to comment on CrossFit or motorsport or whatever, right?
Yeah.
Because you need again that internal expertise, I think.
Okay. Yep.
Yeah. Sorry, you had another question. I'm kind of blanking on it in context.
Ooh, shoot, I'm blanking on it too.
Timelines.
Timelines.
That's right.
Yeah.
That's right. So even though they announce it now, doesn't mean that there's going to be buy in the next week or two.
Yeah.
A process really can take I think the shortest I've seen on the sell side is like 6 months, but that's when a buyer's pretty much already aware we might sell and steps in with a good offer, and then you start off the rest of the process. But I think 9 months to a year can be a realistic timeline for most transactions, especially when you get larger and you have a little bit more legal approvals to go through. So this is likely not going to be a quick thing. I mean, I would say there's one more speculation of why they announced it. Just thought of it. So there's also the case to be made that they've already engaged this banker for a while. They might have tried to run a process. They've just not gotten the bids that they wanted. Right? So the way the process works is you sign up with a client, you work with them, really prepare a business case to investors, prepare all your materials, and then you reach out to potential investors and gather bids from them. And there's a potential that they just didn't get the valuation that they were looking for, so they said, hey, what can we do to solicit more bids? And that's by just opening up publicly and saying, hey, we're looking for another buyer, right?
Okay. Yeah. Interesting. So, but that would kind of come along, or there's a possibility that could come along with the numbers when these bidders were. Is there like a preliminary look at the numbers, and then they submit a proposal, or is it like you kind of are like, okay, we're interested in buying this, here's our proposal? Does that make sense?
Yeah. So the materials that bankers prepare usually have a pretty good view on the business. So from financials to how our operations structured to who's the management team, what's their expertise, how long have they been there. Usually you want to talk about growth opportunities, because usually every buyer who wants to step in, again, wants some internal expertise and idea of what can be the next step.
Okay.
Right.
So it could be a possibility that the numbers just don't look good, and the banker that's connected to a lot of these other PE companies, they're like, nope, we're not touching this. And so they need to come out to other bidders that are more directly connected to the community.
I'd say less so the banker that says, we're not touching this, because they're hired as advisors, right?
Okay, but they're soliciting the other PE companies to come on board.
That's part of the process.
So the other PE companies could be saying no to him, correct? Or
to the bankers, you're saying?
Yes, correct.
I'm thinking more that, potentially PE's already submitted bids, as in, hey, we're willing to pay you, $150, $200 million, or whatever the number was, right?
Yeah.
They bought it for 200. Let's say it only came in at 200.
Yeah.
And the private equity firm says we can't do that, because then we're not
current owner, private
current owner. Yeah. So those are the numbers I'm referring to. They looked at the bids and said, that's not good enough.
I see.
With the universe of buyers that we've reached out to, how can we get more reach?
Okay.
Let's just open it up and say publicly, hey, we're for sale.
Okay.
Because, like I said, that gives you the opportunity, I think, to have buyers you weren't aware of or weren't thinking of to step in.
Okay. And then it can also start almost like a bidding war process in a way.
That too. I mean, that's usually the goal for a banker. Right?
Okay.
That's I think the strategic value that bankers oftentimes bring, in addition to just general advice and knowledge of buyers. Who is a good buyer, who might not be the best fit.
Yeah.
It's usually trying to create a competitive process to have, buyers bid against each other to increase the price.
And will PE ever sell at a loss? Like, is that a possibility, or?
I mean, they prefer not to, right? But sometimes if things just don't work out, before you get nothing, you might have to sell.
It. Okay. Yeah. Interesting. Interesting. That whole side of the thing is going to be, I think it'll be interesting to see the details that come out about it, because it definitely seems like there's something that's underneath that just, the numbers don't seem right for a sell at this point in time. But obviously you're talking about that timeline of like that 5 to 7 year window is kind of the sweet spot, right? So it'll be interesting. The soliciting other bids is kind of like an interesting speculation as to why they made that public announcement, because I could definitely see them potentially losing money on the purchase or sale or sell of CrossFit, if that makes sense.
Yeah, I mean, I've heard someone speculate that they were actually trying to sell last year already.
Oh, really? Okay.
Yeah. Basically, right after the games.
Okay.
But
right
that was
after
before something happened. So start soliciting.
Okay.
Like you said, things were on an upward trajectory.
Yeah.
And so the best time to sell usually is
on the way up.
On the way up, right?
Yeah.
Because you can make the business case. You can point at the chart and say, hey, everything's
trajectory's
moving
going up
to the top right.
Yeah.
It's gonna be great.
Yeah.
But it sounds like that that athlete dying last year just really kind of put a cross there in their plans.
Huge damper. Yeah. Okay, so I think there's been a lot of also just kind of like rumors about, or different like perspectives on how to run the company post sale, maybe. Obviously, there's this one about the kind of entertainment group coming in to purchase. There's also kind of this entity that's talking about gyms banding together and purchasing CrossFit. There's also potentially that entertainment company breaking the affiliates off and purchasing just CrossFit. Mm-hmm. Are either of those two possibilities?
I mean, realistically, I'd say everything is a possibility.
Okay.
Right? As long as you have the support from new buyers.
Okay.
And the current owners are okay and kind of get out of the transaction what they want.
Okay.
I think the breaking up the parts of the affiliates and the games seems tougher in this model, right? Just because you, like you said, it kind of is a full ecosystem. Everything more or less depends on each other. Because the games drive affiliates and
right.
Member signups.
Right.
So it doesn't seem to make much sense to break that out.
Yeah, I would agree with that. I mean, I did see a little clip on Instagram last night of Rich Froning talking about how in 2018, like everything was on the up and up. And then Greg shut down the social media accounts, and he's like, you know, his kind of, I'm kind of paraphrasing here and interpreting, but his kind of thesis was like, look, it gave people something to aspire to be, and like maybe they knew they couldn't get there, but that they could touch that games level physique caliber athlete, whatever. So they would come and sign up for the affiliate. And he was kind of talking about how like the games is kind of the marketing side for the affiliates, and the affiliates kind of drive the games side of things. They both kind of like they're like separate but the same, if that makes sense.
Yeah, I can see that. And but even further, I think so that the games drive affiliates, but the affiliates are essentially, I think, the marketing arms to CrossFit, right? Because they individually post, right, from their athletes going to the games. So it's a cycle, right, of like having interesting or successful games to the affiliates market. They sign up new athletes who then go to the games, right? So it's that's where like that connection, that interdependency comes from, I think.
Yeah. It's always seemed like, personally, I've been a big proponent of like you need to separate the two because they're different. But I think diving into this a little bit more, my viewpoint's changing a little bit. I would like to see them separated, but I don't think there's any way you could do it and still have the two entities exist, if that makes sense.
Yeah, I mean, because you would have owners with more or less competing views, right?
Yeah,
potentially.
Well, you would take the entertainment side and you'd pretty much try and push it as much as you possibly could. But we'll see if that works, because there's an organization out there called World Fitness Project, and they've pretty much started their business model off of that. I think there's some other things in the works for them in regards to like trying to get affiliated with inside of gyms and maybe doing some like gym programming or something like that. But that's kind of their business model, is the entertainment side of the sport. So I think we'll get a glimpse and see if that genuinely works. I think they've probably got a 3-year runway with the capital that they have right now. And then you have kind of that affiliate side of things that drives. I mean, that's their moneymaker in general, if that makes sense. Like they make a lot of money off of affiliates, level ones, all that stuff.
Yeah, I mean, I think there's potentially a business case to be made like under the same ownership, maybe to structure things out a little bit more separately, right?
Okay.
And just look at it as different business units. And I don't know how currently CrossFit management looks at this.
Yeah, right.
But yeah, like I said, or like you said, investing more heavily into just building out the games with, media partnerships. I think you talked before about, some TV rights. I think in 18, 19 potentially getting signed.
Yeah.
Glassman kind of stepping away from that. Which doesn't seem like a smart idea if you want to grow the sport, right?
Or just the business in general.
Yeah. Hey, here's some money for TV rights. No, thank you.
Yeah. And like the other thing too is they had a killer media team. I actually went on their YouTube channel a couple nights ago and looked up some of their old videos from like 2013. Let me see if I can find. I sent it to somebody. There's this one video. It's one of my favorite. It's a little sappy, but it's called "Let Beauty Speak," and it highlights. At the time, CrossFit was kind of changing the viewpoint of like how like it's okay for women to look strong. Basically, one of the big selling points in like 2011, 12 was like strong is beautiful, and so it was like kind of starting to change the viewpoint of what beauty is. It was one of their big things, and it was like performance and health oriented, which is like grassroots. Like that's what CrossFit is, like performance and health. And they made this video, and it was super well done. One of my favorite videos of all time. And you see some of the old school like games nostalgia for sure, but but they had a huge media team that I think really drove them, and it seemed, I think, current ownership, obviously they needed to kind of come back to making money to reinvest it, and a lot of the media was kind of one thing that they decided to cut, it appears, to help expenses, if that makes sense. So I can't remember why I was going on this tangent, but
I think just, if I remember, the media team also had a little bit of turnover, or you said, I mean, Glassman already suspended social media for a while.
Yeah, right. So maybe that was what it was. They just cut the media team when they suspended. So maybe it was Glassman that made that decision. Yeah, I mean, I guess if you don't have social media, you have no job, right?
Yeah, I mean, how do you from a corporation or organizational level standpoint communicate with your affiliates and athletes if that's how you've always done it? Right. You're not just gonna, I don't know, send out letters.
Yeah, I mean, the only thing they were broadcasting during those years was the Open and the games during that time frame. So it was like that was pretty much what their media team was the Open and the games. So I can't even remember where they broadcasted.
Seems super counterintuitive for.
Yeah.
I mean, turned out to be wrong anyways. Right?
Yeah.
So,
right.
I wonder what drove that decision, to be honest.
The law speculated. That's a whole nother podcast. But yeah, maybe that's something they can do to kind of bring back some joy and some love back to the sport, was just that the media content that was created during that time frame was so good.
Yeah.
Expensive, but super good.
Yeah, I mean, I think there's some great examples of other, sports related businesses or just industries that have seen some great content created over the last couple of years that really drove fandom in those areas.
Yeah.
So again, Formula One is an example. I think golf, tennis, NASCAR, all of those have documentaries. On Netflix, which increased popularity like crazy.
Yeah. Right.
And that, from a business standpoint, that helps valuations.
Right.
For
right.
owners, right?
Right.
It's like, hey, look how many fans we have. They all buy merch. They all attend the, games or competitions.
Yep.
And they follow us year round. So and they might become athletes themselves.
Right. Yeah. Real quick, maybe we can hit on: is it possible for affiliates to buy CrossFit, and then kind of wrap up here?
I mean, possible, probably challenging for sure.
Yeah.
There are about 10,000 affiliates at the moment. I think it's roughly the number as far as I'm aware.
And I think one number we heard was 550 million is what they're asking for.
That's a lot of money.
Yeah.
Right.
And so, but I think that calculates out to $50,000 per affiliate.
Yeah, if you do that math,
if
right?
every affiliate were to buy in.
If everyone were to buy in at the same amount. I mean, in the end, it would be something like a crowdsourcing effort.
Yeah.
In getting the money together, and then you have, I think, the scenario in the end of who's running the business and who's making decisions, right? Seems more like a public entity at that point with that many owners.
Yeah.
Right. So you're, and I don't know all the legalities around it. I've never worked on a deal where something like that was pursued, but in the end, you would basically have to, I think, vote almost every year on who
who the ownership was,
who's confirmed CEOs, confirmed leadership, so that you have someone at the helm, and then I think that would drastically change the dynamic in the sport as well.
Yeah,
right, because now you're having votings on who's taking over. That sounds very corporate. That seems to be the thing that people want to get away from.
Right. You know, right.
Let's have a town hall and vote who the next CEO is. And,
right.
Let's look at the numbers.
Right.
I don't know.
Yeah.
That doesn't sound like what.
And then it's want. You would have to have you would have to completely recreate the governance structure for that as well, right?
I would think so. Yeah.
And that would be a whole other hassle that would go, especially if you're trying to coordinate CrossFit gyms like all 10,000 CrossFit gyms to agree on a governance structure, like that seems crazy.
Yeah. I mean, it feels like it would make things move a lot slower.
Yeah.
I think people want some kind of change, the right change.
Yeah.
And I think it's tougher if you have this many owners trying to have a say.
Right.
Things will move slower, I think.
Right.
You know, rather than a single investment group that, you know, where there's like a handful of people who make the decisions together.
Yeah.
That say, this is the course we're taking.
Yeah.
You know, this is a charted course.
Yeah. So you think probably best case scenario for CrossFit is to have kind of like a person at the helm or an entity at the helm drive it forward type thing.
That's what it feels like.
Yeah.
Because you can make the decisions quicker, but it gives you more risk too, right? There's trade-offs everywhere, so it could be that they're making the wrong decisions.
Yeah.
Just like current ownership.
Possibly current ownership. Yeah. I mean, it's so hard to tell with with that death if it really was a poor kind of partnership, you know. But
yeah, you're saying from the games last year,
right?
Yeah.
Because like in all intents and purposes, the CrossFit side of things was growing, right? And you know, it's tough. I'm not super involved in the affiliates, so like I'm just kind of getting like the back end stuff of it, if that makes sense. And you know, sample size super small, but from my understanding is people were frustrated with how the affiliation side of things is going and what all they get from it. Maybe I'm just like in the wrong there and don't have enough connections inside of things. So, you know, it could be that they were on a great trajectory with the affiliates too, you know. But I think that the death of Lazar was a pretty big, like, we're done with the community.
I mean, it's horrible, you know, for that person and, you know, their family and friends.
Right.
But also, you know, it doesn't give you the trust in the organization and that they're able to, you know, it's a sport, so there's always danger associated with it. But you're expecting the organizer to put an event together that's safe for you to go to. And even if something happens, like, you know, you won't die.
Right.
So,
and there's
it's tough.
Yeah. I mean, that's like a whole other podcast, like a whole other, that might be a podcast series, you know? But yeah. Interesting. Well, yeah. You got any last thoughts here on anything or?
Not on this topic. Just appreciate you having me.
Yeah, for sure. Can people get a hold of you, or do you want people to get a hold of you, or for just questions about this at all, or? I
mean, I'm always here at the gym.
Okay.
So find me here at the gym.
Okay. Right on. Well, thanks for listening, guys. Please like and subscribe. We'll catch you guys next time.
Sounds good. Thank you.